We changed the format on this a little bit, and we're going to start off looking at our market environment indicators and what the market environments are across the quarterly and monthly timeframes. And one of the reasons we do this is we want to give a frame as to what are the long-term timeframes saying about these different markets. We're big believers in the impact of multiple timeframe analysis, and particularly the impact of longer timeframes. Each time frame has its own participants that live in that time frame. And so it's important to understand who is operating in the big longer term time frames. So when we look at this, there's some really interesting information that comes up in this. And one of the things we want to look for is when we look at a market, we talk about that in order for a market to become a trend, it has to break out. And then once it breaks out, it has to move into what's called a transition period. And then in the transition period, then it eventually moves to a trend. And it'll stay in trend until it goes into congestion. And there's different states that we kind of typecast. There's different breakout states, there's different transition states, there's different trend states, and there's different congestion states. And maybe at some point we'll do a little class on that, or a little video on it. But one of the things I want you to see is that when we see orange means that these are markets that are in strong trends or strong breakouts or strong transitions within that time frame. So we have the quarterly and the monthly time frames. So when we look into FX, we see a lot of them have really strong monthly transitions or trends. Some of them have transitions and trends, pretty much all of them do. Some of them are confirmed, some of them are non-confirmed. When you see non-confirmed, this is like what our testing shows is that when a market breaks out and the breakout is non-confirmed, this breakout has a much higher likelihood of failing and going back to where it came from. Same thing in transition. So when we break out and we pass off to transition, if transition's confirmed, then we would expect it to follow through. If it's non-confirmed, we actually expect it to fail and revert. And then in trends, you'll see trends that are intact, you'll see trends that are divergent. Trends that are intact are trends that we would expect to continue on. Trends that are divergent, we would be watching closely for the trend to end. So when we look in here, there's a couple things that we see. We see really strong trend metrics across FX, across treasuries and fixed income, across stock indices, across some of the sectors, and in cryptocurrencies. We go up into the quarterly. The quarterly is telling us a different picture, and I'm going to talk about this a little bit today. You see a blend. They're all trend or transition, but only a handful of them in the currencies are actually orange. This means that we're actually seeing the type of behavior that often leads to reversion. Same thing here. Most of the currency FX spot quarterlies are in trend or transition confirmed. There's a handful that are divergent. We go in here and we look at metals that's transition confirmed down. We look at fixed income. Most of them are non-confirmed or divergent. They're non-confirmed or divergent. Then in indexes, they're divergent. And then even some of the sectors, divergent or congestion entrance. So we talk about a concept called a linchpin time frame. So what'll happen is you'll look across a network of time frames, and you'll see maybe some are going up, some are going down, maybe they're going opposite. There'll be what we call a linchpin time frame. And a linchpin time frame is the time frame that's holding the whole structure up. It's holding the whole structure up. If you were to pull the pin, the whole thing would implode. Or another analogy would be putting your finger in the dam. If you pulled your finger out of the dam, the whole dam would collapse. Well, what we're seeing with a lot of these longer term time frames is that the monthly is becoming a linchpin time frame. As long as the monthly keeps pushing, the market can go, in most of these cases, lower. But if the monthly stops pushing, it's going to open the door for the quarterly to revert and the quarterly actually to rally in the face of a downtrend. So this is going to make for some interesting discussion today as we go through this. When we look at the WAM relative strength report for October, you can see that stock indexes rolled over hard. And this is basically off of FOMC in September. When Powell came out and really affirmed, the market was hoping they would start to back off on the rhetoric about raising rates, but he basically pushed on, saying that they were going to continue to raise rates and do so aggressively. So here's the sector ETFs. The sector ETFs, you can see XLU got absolutely crushed. And XLU got a double whammy. It got hit on high interest rates, and it got hit on Hurricane Ian. So there were some big utilities that got absolutely destroyed. And then we have XLY, XLV, and XLP also all really got clobbered. Okay, and you can see volatility popped, which makes sense.